Is Lululemon a good stock to own right now? Should you buy, sell, or hold it? I'm not you, so I can't tell you what to do. I'm just going to walk through my process, and I'm very interested in this at these prices. I haven't bought yet, but let's walk through what's interesting about this company. So, this company's had an incredible run. It was formed in the 1990s, went public, and has at its current market cap of 20 billion. It's a very impressive run in a short period of time for a company that doesn't make software. It has been over $500, so at these prices, it's very interesting to say the least. So, this is a podcast that I like to watch. These guys are actually pretty good, and they have almost 100,000 subscribers, way more than my 500, but they were pitching this as their best idea in 2024. And if you had gone with their best idea, you'd be down 40% right now. But there's a certain point at which something gets so cheap that it starts to look interesting, even to a cheap ass like me. So this is a website called Dataroma, which tells you what some very noted value investors are buying and selling in their quarterly filings. And as you can see, the CEO and the director were buying in 2024 at much higher prices than this. So they liked it at higher prices. And as recently as last quarter, you had two investors that are pretty well known buying it. Actually, Francois Rochon is not very well known outside of the value investing community, but he's a very talented investor in Montreal. And Michael Burry of The Big Short is well known, and 21% looks like a big position, but he actually shuffles his portfolio around quite a bit. And if you check quarter to quarter, sometimes he has completely different stocks. So I wouldn't read too much into that. So this quarter, all new stocks that he bought, except for Estee Lauder, which he sold a little bit of. Last quarter, he bought Estee Lauder and sold everything else. So here's everything he sold. And that prior quarter, there were all these new buys that people were making a big deal about, like Pinduoduo and HCA, which he quickly sold 3 months later. So I wouldn't read too much into his moves, but he did buy the previous quarter. And if you're someone who likes to copycat other people, you are getting it at about 30% less than the price it was at the end of the quarter where he was reported to have bought it. However, you shouldn't just follow somebody and buy when they're buying and selling what they're selling. You should understand why, because if you had bought when he bought and then it dropped 30%, you probably will sell. And so you should understand what's going on. And the story right now is it is cheap. It is very cheap. Less than 12 times earnings. So I've always said you should compare whatever you're thinking of buying to the default, which is the S&P 500 in a low-cost index fund. Traditionally, that trades at about 15 or 16 times earnings. That is very expensive now because it's trading at 30 times earnings. So while normally this is a great default, it is very pricey now, and it makes other things more attractive, especially if you can get a global brand like Lululemon trading at less than 12 times earnings. Things start to look interesting. So looking at the statistics, 21 billion market cap, almost no debt, nice operating margin, very high return on equity, all things you like to see. And they are growing, so revenue year over year is growing. So normally with a low PE like that, you would expect to see a company that's a melting ice cube. It's shrinking. So revenue is growing. Earnings are going down, and we'll go over that in a second. But it doesn't look all bad. So what's the discrepancy? Why is revenue going up and profits going down? Well, you can thank Donald Trump for that, because that's all due to the tariffs. So they do make some stuff in China and Vietnam and India, and they also have production facilities in Canada, and all of that has been hit by tariffs, especially the so-called de minimis exemption. So normally if you ship something from abroad and it's less than $800, you were not paying any tax on it, which is how Temu is able to send people stuff so cheaply from China. But the current administration did away with that, and so these products that they were shipping from Vancouver, no longer you get the de minimis exemption, giving you tariff-free imports, and all the stuff coming from China and Vietnam is also getting hit with tariffs. So that's really hurt their profitability, and the CEO has cut the guidance. And when you cut the guidance estimates on a growth stock, people tend to dump it, and they keep dumping it and keep dumping it until it gets so cheap that it looks like a value stock, which I think is where it is now. So they have some great things going for it. One, unlike Nike and Under Armour, they don't have to pay hundreds of millions of dollars to athletes. So I believe Nike paid Tiger Woods like $100 million, and Under Armour paid Jordan Spieth, I don't know how much, but yeah, Lululemon tends to focus more on giving free stuff to yoga instructors and people like that and influencers, which doesn't cost them nearly as much. So if you look at how much they spend on advertising and things like that, it's less than 5%, whereas their competitors like Nike, it's usually in the 9 to 12% range. So they're spending half as much for marketing as their competitors. It's a premium brand. It's very expensive. Traditionally, because they started out in yoga, most of their, actually almost all of their customers were women, and they made a concerted effort to try to get more men to buy it. And now it's about 2/3 women, 1/3 men. So it's not just 120-pound blonde women doing yoga. There's a guy I know who actually buys a ton of Lululemon, and he is the exact opposite of that. He's in his 50s. He competes in Brazilian Jiu-Jitsu in the 260-pound category, and he's African American. And so every stereotype that you think about the Lululemon customer, he's the opposite of that. And it is pricey gear, but it is very high quality, according to people that I've talked to, both men and women. And so people are willing to pay that. And these tariffs things are what's beating up the price of other companies, especially Crocs, which I also own, which is very cheap. But this one has gotten cheap enough that I ignored it and ignored it. But now it's getting so cheap that it's hard to ignore. So I may buy some common, or I may buy some options on this, because it's gone down so much that even if I sold options at, let's say, 165 2 weeks out, so the options would expire in 2 weeks, I would get $540 for each put that I sold. If it didn't get exercised, I would get to keep that $540. If it did get exercised, that would mean that the price of this dropped below $160, because I'm getting 165 minus 540. So I'd be buying shares at a good price, and if I think it's a good buy at 167, then why wouldn't I think it's a good buy at less than 160? And if you think their problems are temporary, you can buy calls that go out to 2028. And while these are expensive, so it's $52 and each call has 100 shares, so it'll be $5,200 if you want to buy one call option at around today's price, 165. If you think this is going to go up a lot, then by 2028, let's say that you think it'll be 200, then you can buy that for $40. So if it goes above 200 plus 40, which is above $240, you'll start to make a ton of money. And it'll have until January 2028 to get there. And this isn't a recommendation, but I'm just telling you about a different strategy you could use, which I've used in the past. And this doesn't just goes for this, it goes for other stocks, and you can look into it and decide if it's for you. And But one of the things some people like to do is I can sell a put 2 years from now at 165. And I would get $40 right here. So if it goes 2 years from now below 120, which is 165 minus 40, I would lose money. But if it goes above this, I would get to keep that $40 times 100, which is 4,000. So what I could do is I could sell this and get $4,000 for each put that I sold. And then I can use that to buy a call here at 200. So 200 plus 40 is 240. So by January 2028, if it is below 240, or above 125, nothing happens. If it's below 125, I would lose some money. And if it's above 240, I would start making money. But because I'm selling the puts and using them to buy calls, I'm kind of not out any money. And my bet is that it won't go low and it won't stay in the middle, but that it'll go higher. Whereas if you buy the common, you're hoping that it goes higher, but you're exposed to if it stays where it is or it goes too low. And so with option strategies, you can sort of build different payouts, kind of like Lego blocks, where you decide how you want it to look. But anyway, that's an advanced strategy, not for everyone. And I'm not telling you to do it. You didn't hear it from me, but if that's something that interests you, just start reading up on options, and definitely don't start with a complicated strategy. Start with a very simple one. Buy one option, probably a call if I were doing this from scratch, where you put up money and then you make money if it goes up, and then you lose the premium if nothing happens. And then you would, as you learn that and get comfortable with it, you can try different strategies, and they get more or less risky. So if I owned a lot of the common stock, I can sell a covered call. If I was bullish on a stock, I can sell a put. If I wanted to reduce my risk, I could sell a put here at 40. But if I was worried this was going to go bankrupt, I could buy a put here and get 31. So 2 years from now, if the stock fell here, I would be fine. If it fell here, I would lose money. But if it kept falling, I would be okay, because the money I lost from this put would be made up with the money I made on this put. And again, so it's just like building something with Lego blocks. You can take the different blocks and create whatever exposures you want. And that's what I like about trading with options. But if you don't know what you're doing, it can be risky. So if I didn't sell this and buy this, if I just sold this and the company went bankrupt, I would lose a lot of money. And I could sell this and buy this and I'm protected, but instead of getting $40 in premium, I took that 40 and I bought $31 of protection. So I only got $9 of premium. So I have less money to buy a call option. So different strategies have different payoffs and different rewards. But anyway, that's my thoughts on Lululemon. Are you guys looking at this? Are you long, short? Let me know what your thoughts are. Leave a comment below. If you want to support the channel, there's a link to Robinhood where you can get a free stock, and Robinhood is one of the apps that I use. It's got the lowest margin rates that I found. And if you want to support the channel, there's a Buy Me a Coffee link. Have a great day, everyone.